right, welcome back to the Tech Corner. I'm George Tillis, Senior Markets Contributor here with the Schwab Network. On this week's edition of the Tech Corner, we're going to be covering megacap company Amazon. Now, Amazon is a global platform company that sits at the intersection of e-commerce, subscription services, digital advertising, and cloud computing. The company operates through three primary segments. Its North American segment, which constitutes about 61% of sales, its international segment, and its Amazon Web Services segment as well. Now, Amazon is not just a first-party online retailer. It is also one of the world's largest third-party marketplaces, where it earns fees and fulfillment revenue from sellers. And it is a majority advertising revenue where brands and merchants pay to reach shoppers with high purchase intent. Over time, Amazon has become a dominant player in various sectors by offering an extensive range of products and services. While designated as a consumer discretionary stock with its large e-commerce platform, the company also holds a large role in cloud computing, digital streaming, and advancements in artificial intelligence. Now, despite being the smaller segment in AWS, a significant portion of Amazon's income is driven by its AWS division, which offers a comprehensive suite of cloud services, including compute storage, database, analytics, as well as machine learning. Now, when it comes to competition, Amazon faces it across multiple business venues. For instance, Walmart and Costco are major competitors in the retail segment, both online and in physical stores. Microsoft and Google compete with Amazon in cloud enterprise services, which are rapidly gaining market share over time. Alibaba Group and Shopify are significant international domestic competitors also in the e-commerce space. Now let's look at the unique value for Amazon. First off, the unique value proposition lies in its extensive integrated ecosystem that combines e-commerce, cloud computing, and digital advertising. It has the value-generating ability to leverage vast amounts of consumer data across its platforms, which enhances its targeted advertising capabilities. AWS provides a broad suite of infrastructure and platform services that underpins a meaningful share of Amazon's operating profit and funds reinvestment across the entire company. Now let's take a look at some more recent news on Amazon. Going back to October 30th of this year, the company reported its Q3 results, where it actually beat both on the top and bottom line. Total revenue grew 13% year over year to over $180 billion. While on a GAAP basis, the company beat estimates at $1.95, up 36% year over year. More importantly, when you dig down into the segment composition, Amazon Web Services generated $33 billion for the quarter. That was up 20% year over year, but also sequentially quarter over quarter up 17%. Operating income also came in around $17.4 billion, approximately 10% of total sales. However, one sticking point, and this actually might be the reason why the stock gapped higher than back down, is operating margin came in around 11% of sales. This was higher year over year, but down versus Q2, where they generated 11.8 year over year growth. This suggests there's a higher level of capital expenditures that need to be absorbed. Now, most recently, just going back to the 17th of this month, OpenAI is reportedly in preliminary discussions with Amazon to raise at least $10 billion from the company. This deal would also involve the company using Amazon's own Trainium AI chips used for large learning model programming. Now let's take a look at some of the positives for Amazon. First off, its Amazon Web Services division is experiencing accelerating growth, with a revenue run rate exceeding $125 billion on an annual basis and a $200 billion backlog driven by its cloud and AI expansion. Amazon's Trainium AI accelerators are gaining traction, with Trainium 2 showing full subscription growth of 150% year over year, positioning AWS as a competitive leader in AI infrastructure. Amazon's strategy to leverage its expansive data center footprint positions it to dominate AI infrastructure, with AWS expected to benefit significantly from government contracts and AI demand. Advertising continues to scale as a high-margin retail media business, and ongoing logistics and fulfillment optimization supports retail margin durability. Subscription services like Prime Video are other growing revenue streams with high margins, including sponsored ads, display, and video advertising. Amazon also demonstrates outstanding profitability relative to its own historical averages, as well as to consumer discretionary peers. For example, if you look at the EBITDA margin in the past 4 quarters at 20%, this exceeds the 5-year average by about 600 basis points. Net income margin is quite high considering other retail peers like Costco and Walmart at 11% of sales. This is significantly higher than the sector median of 4%, but also higher than Amazon's 5-year average around 5.62%. Now, despite the positives I just mentioned, we also have to address some of the concerns for Amazon. Despite growing 20% year over year for Amazon Web Services, research estimates that AWS's market share at approximately 29% is declining over time, losing market share to companies like Microsoft with the Azure platform, as well as Google Cloud. This highlights significant competitive pressures in the cloud market. Amazon's cloud computing segment also faces potential oversupply issues due to rapid data center buildouts outpacing demand. which could lead to a buyer's market and intensified price competition. Heavy capital expenditures and the potential risks of AI overinvestment pose concerns for Amazon's free cash flow and long-term financial stability. And lastly, Amazon's e-commerce business, while formidable, continues to struggle with lower margins, which could pressure overall profitability and free cash flow going into the next 2 years. Now let's take a look at the technical picture for Amazon. The underlying indicators are neutral and beginning to show slight signs of bullish improvement. For example, the stock demonstrates a slight positive annual return with a 52-week price increase of approximately 3%, yet year-to-date it's grown less than 6%, underperforming the broad market using the S&P 500 as a benchmark. Despite this, the stock is also down approximately 7% from the year-to-date highs established early in February. The stock is also in a confluent zone of moving averages, including the 10, 20, and 50-day moving averages. Recently, Amazon reclaimed the 50-day moving average, and price remains above the 200-day moving average, which suggests the stock may be setting up to advance from current levels as the end of 2025 nears. Near-term, momentum as measured by the daily MACD indicates that near-term price action may turn bullish, and RSI above 50 and rising suggests institutional accumulation. Now, in summary, Amazon remains a dominant platform across e-commerce, advertising, and cloud. AWS's innovative solutions, such as Trainium AI accelerators, provides a competitive price-performance ratio, reinforcing its market leadership. Additionally, Amazon's vast distribution network and Prime membership program enhances its value proposition by delivering unmatched convenience and speed to customers. Going forward, the core bull case continues to rest on retail margin durability from fulfillment scale and Prime, fast-growing advertising monetization, and AWS's re-acceleration tied to AI workloads and custom silicon. Over time, investors will closely monitor AWS's growth versus Azure for Microsoft, CapEx to free cash flow conversion rates, and regulatory and legal outcomes which can drive near-term earnings volatility and price action to come. Please don't forget to like and subscribe to the Schwab Network. We'll see you next week.